On April 7th, 2026, the man who built the largest hedge fund in human history sat down and wrote 6 words that should terrify every investor on the planet. We are in a world war. That's not some random influencer trying to scare you for clicks. That's Ray Dalio, founder of Bridgewater Associates, managing roughly $90 billion in assets, telling you publicly, on the record, that the global order as you know it is breaking apart. And he didn't just say it vaguely, he mapped it. He built a 13-step cycle that tracks how world wars begin. Every single step, from rising trade tensions all the way to full-blown military conflict between major powers. And according to his framework, we are currently sitting at step 9. Step 9 out of 13. That means 4 steps away from all-out great power war. And the last 2 times humanity was at this exact step, 1914 and 1939, the world didn't stop. It accelerated. Most people are going to hear this and do nothing. They're going to assume the ceasefire with Iran means everything is fine, that things are going back to normal, that the market will just shake it off. But a small group of investors are going to understand what Dalio is actually warning about, and they're going to position themselves before the rest of the world catches up. Today, I'm going to break down exactly what Dalio's framework says, why the data is confirming it in real time, and what this means for your money. Let me give you some context on what just happened, because the timing of Dalio's warning is not a coincidence. On February 28, 2026, the United States and Israel launched coordinated airstrikes on Iran, an operation the Pentagon named Epic Fury. Iran's supreme leader was assassinated. Iran retaliated with missile strikes on Israel, US bases, and allied countries. And then Iran did the one thing that nobody thought they'd actually do. They closed the Strait of Hormuz, the waterway through which roughly 20% of the world's oil flows every single day. Within a week, oil went from $67 a barrel to over $111. Dated Brent crude hit $144, the highest price ever recorded since Platts began tracking it in 1987. The supply disruption from the Hormuz closure was roughly double the record set by the 1956 Suez Crisis. This wasn't a drill. This was the largest energy disruption in modern history. Markets cratered. The S&P 500 fell below its 200-day moving average for the first time since May 2025. All 3 major U.S. indices hit their 2026 lows on March 19th. Gold surged past $5,400 an ounce. Gas prices climbed above $4 a gallon. Then, on April 7th, 2 things happened within hours of each other. First, Dalio published his warning. The big thing: we are in a world war that isn't going to end anytime soon. Second, Trump announced a 2-week ceasefire with Iran, brokered by Pakistan's prime minister, less than 90 minutes before his own 8 p.m. deadline. That morning, Trump had posted on Truth Social that a whole civilization will die tonight. Oil dropped 15% overnight, stocks rallied, and everyone exhaled. But here's what Dalio is saying. That exhale is the most dangerous thing you can do right now. Because what just happened with Iran isn't the story, it's a symptom. And if you don't understand the bigger picture, you're going to be caught completely off guard by what comes next.
Here's what you need to understand about Dalio's framework. He didn't just wake up one morning and decide the world is falling apart. He studied 500 years of great power transitions, every major empire, every world war, every economic collapse. And he found a pattern. That pattern follows 13 distinct steps. They always happen in the same order, and they always lead to the same place. The early steps, steps 1 through 4, are about rising economic tension, trade disputes, tariff wars, sanctions, currency manipulation. Sound familiar? We've been living through that for years. Steps 5 through 7 are about alliance hardening. Countries pick sides, military budgets explode, proxy wars begin. The world splits into 2 clear blocks. And that's exactly what's happened. On one side, China, Russia, Iran, and North Korea. On the other, the United States, Europe, Israel, Japan, and Australia. These aren't loose associations. These are hardened military and economic alliances. Steps 8 and 9 are where things get dangerous. Step 8 is the weaponization of strategic choke points, energy, shipping lanes, semiconductors. Step 9 is what Dalio calls simultaneous multi-feeder conflict, multiple shooting wars happening at the same time across different regions involving overlapping alliances. Look at what's happening right now. Russia and Ukraine, Israel, Gaza, Lebanon, and Syria, the US and Iran, Yemen, Sudan, and the Gulf.
Dalio counts 4 active shooting wars and multiple non-shooting wars, trade wars, technology wars, capital wars, and geopolitical influence wars, all happening simultaneously. This is step 9. And the last 2 times the world reached this exact step, 1913 to 1914 and 1938 to 1939, it didn't stop here. It kept going. Step 10 is domestic political suppression. Step 11 is direct combat between major powers. Steps 12 and 13 are wartime economic controls, including, and this is a detail almost nobody is talking about, the possibility that markets get shut down entirely. That happened in both world wars. It could happen again. Now, Dalio isn't saying all-out war between the US and China is guaranteed, but he is saying the probability is high enough that ignoring it is financial negligence. He estimates a 30 to 40% chance of a Taiwan conflict, a 40 to 50% chance of North Korea escalation, and a greater than 50% probability that at least one major new war starts or an existing one intensifies within 5 years. But here's where it gets personal, because Dalio's warning isn't just about geopolitics, it's about your portfolio. And the financial data right now is flashing red in ways that most investors are completely ignoring. Let's start with the debt. As of March 2026, U.S. gross national debt hit $39 trillion, rising at roughly $7.2 billion per day. But here's the number that should genuinely alarm you. Annual interest payments on that debt now exceed $1 trillion. For the first time in American history, the government is paying more in interest than it spends on the entire national defense budget. Think about that. The United States is spending more money servicing its debt than it spends protecting the country. And the CBO projects interest payments will reach $2.14 trillion per year by 2036, nearly 5% of the entire economy every single year just in interest. Dalio calls this plaque in the arteries, debt payments squeezing away buying power, squeezing away flexibility, until eventually the system suffers what he describes as a financial heart attack, a sudden multi-organ failure of the economy driven by simultaneous military, trade, and capital wars. Now look at valuations. The Shiller-Cape ratio, the most widely used long-term valuation measure, hit 39.8 in March. That's more than double the historical average. The only 2 times it's been this high were the late 1920s, right before the 1929 crash, and 2000, right before the dot-com collapse wiped out more than 40% of the market. And then there's gold. Gold gained 64% in 2025, its biggest annual gain since 1979. It hit an all-time high of $5,110 per ounce in January, then surged past $5,400 during the Iran conflict. JP Morgan's target is $6,300 by year-end. But here's the detail that most people miss. Central banks globally have been buying more than 1,000 tons of gold per year for 3 consecutive years. These aren't retail investors speculating. These are the institutions that actually issue currencies quietly moving into gold. The people who print money are buying the thing that money can't devalue. When central banks do that, it means something.
And this is the part Wall Street doesn't want to talk about, because Dalio's most controversial claim isn't that we're in a world war. It's that America might not win one. Here's how he puts it. While the United States appears to be the most powerful country in the world, it is also the most overextended major power and the weakest at withstanding pain over a long period of time. He backs this up with a comparison that is genuinely stunning. The US maintains roughly 750 to 800 military bases across 70 to 80 countries. China has exactly 1 foreign military base. 1. In Djibouti. And as Dalio writes, history shows that overextended powers cannot successfully fight wars on 2 or more fronts simultaneously. When the US committed forces to Iran, it simultaneously weakened its deterrence in Asia, Europe, and the Pacific. China, Russia, and North Korea are watching. They're studying US munitions expenditure, logistics strain, and political fractures in real time. And here's the part that makes Dalio's framework especially uncomfortable for Western investors. He explicitly states that China and Russia appear to be the relative economic and geopolitical winners from this war. China consumes 80 to 90% of Iran's oil output. The Hormuz blockade that crippled Western energy markets barely touched China's supply chain. Russia provides additional energy to China. Both avoided the shock that hammered the West. Dalio's conclusion?
The key to winning wars isn't raw power. It's the ability to endure the most pain for the longest time. And right now, with a $39 trillion debt, $1 trillion in annual interest payments, crumbling infrastructure, and a politically divided population, America's pain tolerance is lower than most people want to admit. Now, some of you are thinking, this sounds extreme. Are things really that bad? Let me show you why Dalio's comparisons to 1914 and 1939 aren't hyperbole. In 1938, the Munich Agreement was signed. Neville Chamberlain came home waving a piece of paper declaring peace in our time. Markets rallied. Investors exhaled. 9 months later, the Second World War began. Dalio's argument is that today's Iran ceasefire is this generation's Munich moment. Markets pricing in back to normal, while the structural forces driving conflict haven't changed at all. The 1913 comparison is arguably more disturbing. World War I wasn't started by an obvious aggressor. It was triggered by miscalculation, alliance obligations, and overextension. In 1913, most experts believed economic interdependence between great powers made war impossible. They were wrong. Now look at the financial parallels. In the 1973 oil embargo, triggered by the Yom Kippur War, stocks fell more than 40%. The Fed raised rates from 5.75% to 12% and still couldn't contain inflation. Unemployment nearly doubled. That crisis was caused by a supply disruption of roughly 5% of global oil. The 2026 Hormuz blockade disrupted 20%, 4 times worse. Oil surged more than 90%. And we entered this shock with valuations at dot-com era levels, national debt at record highs, and interest rates already elevated. The math does not look good.
So why are most investors sleepwalking through this? The answer is the same as it's always been: psychology. Right now, markets are pricing in a quick return to normal. Oil dropped after the ceasefire, stocks bounced, and the collective sigh of relief was almost audible. But Pepperstone's research division concluded that markets are unaffected despite historically elevated geopolitical risk, and that when geopolitical risk actually crystallizes, market reactions are swift, nonlinear, and highly correlated. Translation: when the next shoe drops, it drops everywhere at once, and it drops fast. That ceasefire expires in approximately 2 weeks. Iran's nuclear capabilities are intact. The alliances haven't softened. The debt hasn't shrunk. The overextension hasn't reversed. Nothing structural has changed. And Dalio flagged the greatest risk period for a Taiwan confrontation as 2028, just 2 years away. So what are the smart players doing? Warren Buffett has been raising cash. Central banks are buying gold at rates not seen in decades. Dalio himself recommends diversifying across currencies and asset classes, reducing concentration in any single country, and holding real assets, particularly gold and commodities, as a hedge against both inflation and the currency debasement that comes with war financing. Bridgewater has materially increased its exposure to gold, commodities, and inflation-protected securities. Dalio's all-weather portfolio framework explicitly hedges for exactly the kind of scenario he's describing: inflationary, war-driven, and debt-constrained. Now, I want to be fair here. There is a bull case. Markets have historically rallied after wars begin. After the 2003 Iraq War oil spike, the S&P delivered roughly 25% gains over the following year. Nuclear deterrence has changed the calculus of great power war, and Dalio himself expressed cautious optimism about the planned Trump-Xi meeting in Beijing this May, saying a successful outcome could meaningfully reduce tensions. But here's the thing Dalio keeps repeating: the biggest risk isn't that things get worse. The biggest risk is that people assume things will get better without any structural reason for that assumption. Hope is not a strategy. And right now, hope is the only thing propping up most portfolios. So let me bring this together. Ray Dalio, arguably the most important macro investor alive, is telling you publicly that the world is at step 9 of a 13-step cycle that has preceded every world war in modern history. He's telling you that markets are mispriced. He's telling you that the ceasefire doesn't mean the crisis is over. And he's telling you that the probability of further escalation is above 50%. You can disagree with him. Smart people do. But you can't ignore him. Because the data, the oil shock, the debt levels, the CAPE ratio, the gold surge, the alliance structures, the military overextension, all of it aligns with his framework. The people who build wealth through periods like this are not the ones who predict the future perfectly. They're the ones who prepare for more than one outcome. They diversify. They hold real assets. They reduce concentration risk. They have a plan written down before the fear kicks in. Dalio isn't telling you to panic. He's telling you to stop sleepwalking. The world order has changed. The rules have changed. And if your portfolio is built for a world that no longer exists, you are exposed in ways you don't fully understand yet. The question isn't whether the next crisis will come. It's whether you'll be ready when it does.